Welcome to the Private with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here with the Private Lenders Podcast. Thanks for tuning in. We have a special guest today. We'll get to that just in 1 second. Quick reminder, if you haven't done so already, go check out hardmoneymastermind.com. Make yourself a free account, join the conversation, take some of the trainings. A lot of members in there now, maybe 500-600 members in total. So yeah, definitely go check that out, hardmoneymastermind.com. All right, today, special guest. We have Bryant Mason on the show with Mid-Atlantic Financial Group, the owner of Mid-Atlantic Financial. And he brokers and places loans with all different sources of capital. And it's basically, we wanted to have Brian on because we kind of have our blinders on a little bit living in the private money world. We do basically one loan product, like maybe two or something like that. And we live in this little private money world. And we wanted Brian to come on to talk about some of the things he's seeing now out in the capital markets, how it's been the past handful of years, and what we're all dealing with in terms of that stuff, takeout financing and other long-term sorts of capital. So Brian, thanks for taking the time. Thanks for being with us.
Thanks for having me, man.
Absolutely. Yeah, no. Where should we start? You want to just give everyone a little bit of background on yourself and your business and what you've been doing up until now?
Yeah. I started in residential lending about 20 years ago. Did that for a while, got a job at Merrill Lynch, did wholesaling with them for 6 years, and then started in the hard money space and with a great hard money company. Only did hard money deals for a while. Then branched out from that, started doing a little bit of, the small commercial space, up to about 10 million bucks, which included fix and flips, long-term residential lending, multifamily, and office space, retail office space. So that's what we mainly do right now. And different world out there now than it was a few years back.
Yeah, absolutely. Let's rewind, I don't know, 8 years ago when institutional capital came in. Well, let's rewind like 15 years ago. And was it mostly, it was mostly just private capital then, right? It was mostly private capital. You had institutional lenders, I guess, on the commercial side, right? The small, the silver trees, the velocities on the kind of commercial side. And then what was it, 8 years ago, I guess, when institutional capital came into the residential fix and flip space? Does that sound right?
Yeah, it was 8-9 years ago. They started doing fix and flips and kind of opened it up to, people who wanted to buy and hold, to holding.
Yeah, the rental 30s and all that.
Rental 30s. They also do they were doing some 2-year bridge loans as well. And
what were the terms then? What we're going to talk about then, and then we're going to talk about now, because I think it's good for people to understand and learn kind of the comparison. Like, what were the terms then, and like, what was the process? Like, what was the time frame, and what was kind of the process to get those deals kind of through?
Yeah, I think initially, terms wise, you were probably looking at 7-8% on the long term stuff, 3 or 4 points. Time frame was usually about 30 days, give or take. Depending upon third party reports and when they got those back. Now, it's totally different. I mean, on long term, high as 9%. Turn times are 32 to 45 days. I would say average is about 40 days to get that stuff done.
And now, meaning like in the past 6 months or so, would you say that's about
in the last, I would say 5 to 6 months.
Okay. So, all right, obviously we know interest rates have gone up both long-term and short-term pretty much across the board. Have you seen underwriting getting tightened too, additional documentation requirements, or just straight changes of LTVs or whatever?
I've seen changes happen, like it could be week to week. Underwriting, it seems like guidelines change frequently. I mean, I've had situations where there were deals in process under one scope of guidelines, and maybe 2 weeks later they come and say, oh, guidelines have changed. Now, in addition to what we have, we need X, Y, and Z as well. And, in a lot of cases that might kick someone out, depending upon what they're asking for. It could be a reserve requirement, a different reserve requirement. I mean, it could go from 3 months to now they need 7 months, or it might be 12 months. I saw a deal that I just closed last Friday go from initially a 3-month reserve to 12-month reserve. Luckily, this person had it. So, with the underwriting changes, it can put a kind of a damper on a deal if, the deal is tight, or you don't have a borrower who has access to more capital, or who might be someone that's new in the industry as well. So it can be difficult.
Yeah, it's brutal when it changes like mid-process like that. It's not good for anybody, like for the lending company, for the borrower. It's just, and there's so many things that happen behind the scene that we really aren't experts in, like when it comes to secondary market securitization.
Yeah.
Do you hear talk about that come from the lenders where you place deals, or do they kind of keep that like in back office and quiet?
Well, I think, it depends. It depends on the relationship you have with your rep at that particular lender.
Okay.
I have some of the reps who are pretty transparent and candid, and maybe information they shouldn't share, but they're like, hey, this is what's going on. It might be best to maybe move this some other place because your deal is never going to close, which is not what you want to hear. But I have relatively good relationships with most of my lenders. So, the reps are pretty candid about what's happening. And then there are those cases when you don't know. They just, hey, this doesn't fit anymore. And we can't do it. And sorry. Or they're just making excuses of why they can't do it. So,
yeah, it's similar to back in the mortgage wholesale retail days of 07 or 06, 07, all of a sudden you go in and this is the craziest part of this business is they took the consumer mortgage game and they turned it into the investment mortgage game, with the capital sources and the amount of liquidity that was out there and the amount of transactions that were out there. Like it was wild. Because it never used to be like that. And that's not to say that on mostly the commercial stuff, there wasn't institutional capital available. There always was. And there was actually bank and institutional capital available for fix and flippers and stuff like that. I mean, we remember banks, local banks. I'm not saying Wells Fargo's of the world, but like local banks, when we started, 07 and, 07, 08, 09, 10, 11, 12, whatever, like a lot of those local banks would do these deals, these fix and flip deals. Were they easy to push through? Hell no, they weren't easy to push through, but like they were available and the rates were cheaper. And, you had to probably have a deposit account with them and a relationship and your spouse probably had to sign. But for the good developers that were local, that was a good option. But then after the institutional capital came out, Wall Street money, gigantic companies, because there's so much liquidity and they were getting capital for cheap and it was easy for them to get capital. Then they all kind of just sprouted. And, the Rock Capitals, the Pier Streets, household names that some people have good relationships with, some don't, kind of came out. And, it was interesting. So what are, like, let's talk about fix and flip. And I know you told me earlier that you haven't had a lot of fix and flip deals recently. No. But what's the, and again, like there's different types of pricing, right? Like different folks have different kind of pricing, but like, let's say you were to make no money on a deal. What would be like the par rate for a regular lender that you were doing a fix and flip loan?
Par rate for a regular lender would be 10.49.
And any points?
2 points. 10.49, 2 points.
Before you made $1.
Before I made a penny.
Yeah. So call it 10.5 and 2 points. Chris and I looked at a pricing sheet from a lender recently. And again, like we've never done this. We've only been private capital, but it's good to see kind of what's out there. And what was it? 11.25 and a 1.25 and $1,000 funding fee. I think.
Yeah,
Which
that was their minimum buy price.
Yeah.
And
wow.
then,
Which is
and
the
then
same, which is like 10 and a half and 2, similar to
Yeah.
that.
It's like 10 and a half. Yeah. Now, granted, Jason, in that 10 and a half and 2, there's some other cost involved.
Yeah.
There's probably an 800 processing fee. There's, $500 for underwriting, another $300 for something else. So there are some additional costs in that as well.
we always wonder what it looks like behind the scenes at companies like that, these capital providers, because their whole model is based on volume, which they had the past 5 years, right? They're deploying billions, literally.
That's right.
But without the volume, I mean, which we all know is like decreased. Without the volume, what does it look like over there? Like,
well, I'll tell you, man, they're cutting LTVs, number one.
Mm-hmm.
And I'll give you a snapshot of that. I had a borrower yesterday, long-term rental. He in Pennsylvania. He bought the property, rehabbed it, great credit. LTV is there, and they priced it out for him 70 LTV. Guys got like 780 credit, 70 LTV on a 30-year long-term rental. His rate is 8%.
That's rough.
That's rough. That's rough. When 6 months ago, you could probably get 6.5.
6.5 and probably 80 LTV.
And 80 LTV. That's right. That's a huge difference.
I mean, it's a moving target for sure that you're dealing with, but I would still think that your particular niche with Mid-Atlantic Financial Group is not a bad place to be right now. Like, you have to deal with some of the stuff that we just talked about, but like all the relationships you have, all the like industry knowledge that you have of where you can take what kind of deal is probably, to have those options these days, it's got to be a pretty good niche, I would think.
It is a niche. I mean, but you're seeing the kind of the cupboard of lenders shrink a little bit.
Mm-hmm.
And I would say what I tried to do is have 3 to 5 in each category that I dealt with. I had some go-tos, and then I had like, hey, if these guys can't do it, I can send it here. Well, instead of 3 to 5, that number might be 1 to 3 now, because everybody isn't doing everything, and because the guidelines and underwriting criteria have shrank, it gives you less to deal with. But like I told Jason recently, it's like, deal flow. I still get good deal flow. Obviously, it shrank a little bit, but the deals are better, which is a good thing. Now, no one is getting the terms they were getting 6 months ago, but they're still able to get the deals closed, and that's the main thing. That's where everybody wins.
We've seen the same thing. Like, quality's up, but like, quantity's a little bit down. Not crazy down, but it's different.
And here's the interesting thing, which I think like folks that are similar to our situation and your situation can benefit in a time like this, because all of those companies that, let's just call it competition and had institutional back capital, like Chris said, they're a volume game. It was a race to the bottom in terms. They needed to do volume with skinny margins to do so, and there's not volume there. We don't need to do volume. You don't need to do volume. Those guys all had their product, which was cool, bridge, fix and flip, rental 30, whatever the case is. Like, by having the ability to kind of, and it either had to fit in the box or didn't fit in the box, right? Every deal we do is unique, right? Like, there's hey, let's get on the phone. Let's build rapport with the client and let's figure out if there's a deal to be had. If they don't have good cash, if they don't have a good asset, there's nothing to be there, and that's a given. But like, we've been talking about this over the last few months. It felt like 2012 a lot. And we've been doing a lot of like very creative types of deals, lots of cross collateral, multiple borrowers and guarantors, different asset classes that we've lent against, which is a good thing. Those companies can't compete with that. No. They just can't, because they want to do whatever, 1,000 rental 30 loans a month or hundreds of fix and flip loans, and make 25 basis points or whatever, a small amount to do scale and do tons. Like, it's labor intensive. They need high staff. You could be a one-man operation, or you can have a small team and still be very successful. Like, that's right. I don't know how many deals you try to do a month, but like, if you do a few deals a month, you've got a good business. Inside our operation, it's the same thing. We just need to do a few profitable deals every month, and we're good. I don't need to deploy, $50 million a year or $50 million a month and stuff. Like, it's like, hey, let's do a few good deals at decent loan amounts and it's fine. And we can do fix and flips. We'll do bridge loans on commercial properties. We'll do, unique situations that make sense. And I would guess in your case, just because you have a few different lending sources as well, it's the same thing. And it's like, hey, I just want to do a few deals a month and I'm happy. And no matter what the market presents, I'm 100% confident that anybody can do a few deals a month. Do I think you can do? Yeah. Do I think, like, am I going to put my money on an operation that needs 50 deals a month to break even? Hell no. Am I going to put my money on someone who's like, hey, I just have to do a few deals a month and, and I'm going to be good. And we're going to make a good amount of money on those. And I think
that's right.
I think the folks that are positioned that way are going to be ahead.
Yeah. I mean, listen, I had a conversation with a lender this morning one of the big guys, who they were doing a lot of volume. Of course, she said, volume is down. What they're trying to do now is maintain the staff. They don't want to lay people off, but because they're doing so few deals are coming in, they have to. They don't have a choice. I mean, it's kind of hard to, if you're focusing on, if your business has been built the way you just described, where you're trying to get, 1,000 deals a month and you go from 1,000 deals to 300, how long does that last? Unless you just been stacking for the last, 5 or 6 years. These guys won't be able to survive. And that's what we're going to see, I think, in the coming months. There are going to be a lot of those guys who are going to go away.
Yeah, we're gonna see layoffs there, just like we did in the conventional mortgage industry throughout this year.
Right.
They're just quicker to move because they're bigger. Like they see the trend and they come, and they're big established companies, sometimes bank owned, and they start the layoffs right away. They're like, boom, downsized by 15% or whatever it is. And you're right. I think some of these investment type lenders are hanging on or attempting to. And I think first quarter of 23, we're going to see those layoffs coming too. They're smaller companies that might not be like, press releases and news articles about it and such, privately owned and what have you. But yeah, that'll be coming throughout the industry. It's a logical prediction, right?
And I think we all personally can attest to, just because we've been in this business a long enough period of time, is that there's always deals out there for that match the types of capital that we all have. And again, they might not be your traditional fix and flip, but there's always time that people need capital and they're willing to pay market rates for them, even if the market rates are higher. Our rates have stayed, obviously have stayed the same in the private sector, but there's always going to be a day that, an operator of a commercial building has a $400,000 property free and clear, and they need $100,000 for working capital. They need $100,000 to go buy another property, or they need something inside their commercial business, right? There's always going to be a property that's going to be at foreclosure. That's going to be a really good opportunity and a good buy that's distressed that a flipper is going to jump in on. They don't care if the interest rate's 5%, 13%, 20%, doesn't matter, right? At the right purchase price, the numbers work. So
that's right.
Is there going to be 100 of those a month for folks per firm? Probably not. But what do we care? So that's kind of what I feel like I don't want to use the word preach. That's not the right term, but we communicate a lot. It's just like, familiarize yourself with the types of deals that you like doing, and just don't get yourself involved in an operation that you're contingent on doing tons and tons of deals at tiny, tiny margins, right? Get yourself involved and have the ability to have, do a few really, really profitable deals, and it works. Like, would you rather do one deal to make 10 grand, or would you rather do 4 deals to make 10 grand?
That's right.
To me, that's common. To me, that's common sense. But
common sense.
That doesn't seem that's the case for everybody.
Yeah, and all that being said, we don't need to do tons and tons of deals every month. But in order to get the good ones, we do need tons and tons of leads.
That's right.
We need a lot of lead flow to
right.
Pick out the good ones and make the right ones work.
That's right.
Viable opportunities. So lead flow is paramount, just like it always is.
Mm-hmm.
And it's just become a game of execution instead of price. If you can get a deal done, you're going to have deals. And 6 months ago, it was just a price game. There's too much capital in the market. And when there's too much capital in any market, finance guys start doing silly stuff with it. because they
That's
get
right.
greedy, right?
That's exactly right.
Every time. And we've all seen a couple market cycles now. And we're going into, a changing market now, and we have been there for a little bit. I don't think it's going to be quite as drastic as like everything that went down with the residential world in 2008. Real estate's a lot more responsibly underwritten in this most recent buildup. Granted, the price appreciation got pretty silly. And so in some of the residential world, we're going to see corrections there. It's already starting to happen. But there wasn't a whole bunch of crazy, irresponsible loans being made so much. It was just an oversupply of capital, which brought that price way down. And that's correcting now too.
Exactly. And we got to admit, we kind of like it this way, right? I mean, we have to go through this because you're right. I mean, 6 months ago, 7 months ago, there was all this capital, and people would leave you for, a quarter of a point. Oh, I can get this there, so I'm going to go there. Now it's more so, like you said, if you can get the deal done, you'll have a client. If you can get the deal done, because they've been other places, and that's what I see. And when they come to me, and if I tell them I can do it, they usually stick, because they're not shopping, because they can't get any better.
There's no point to shop.
I mean, you're right. Which is a good thing.
It is a good thing. We do like it in our niche in particular when things get a little shaky.
Yeah.
Right. Because we, control our capital. We know we can close. We do our thing. And we just keep it moving and be careful on underwriting, basically.
Well, and I think it's important to understand what types of capital is out there when you're underwriting, and if there's competition or not. Because listen, we've sent deals to you either for refinances or just for folks that want a cheaper term than we can offer, and vice versa. You've obviously sent deals to us over the years, and a lot of them are just like, hey, it's not like, hey, they're the only place in town. Like this is this is all you qualify for. It's more of like, these guys have a really good deal and they need to close in 3 days, 4 days, 5 days, 6 days. Like this is going to be your option, right? So it's good because you have multiple options to do so. And if you're a lender, one of the things we always get questions for in the Mastermind group is like, why would anyone pay 13-3 and put down 30%? 30% down. There's cheaper options and there's higher leverage. That could be, right? That could be. And Bryant, I'm sure, can attest that, hey, if you have very high credit, you have very high liquidity, you have experience, and you want to wait 30 days plus to do a deal, then I'll get you cheaper capital. There's no doubt about that. But if you need a faster solution, you have a 679 credit score, not a 680 credit score, or whatever the requirement is, and you don't want to go through all the headaches on stuff. Private capital might be more, right? Yeah, you're going to need to put, or hard money bankers might be better. Yeah, you're going to need more cash in, and it's going to be more expensive, but it might just be easier, and it's not worth the hassle.
It is easier.
Yeah.
I mean, listen, I'll give you an example. It's like if a deal that I bring to you, like I have comfort in knowing that once you look at it, if you tell me you can do it, I know you're going to do it. It's just a matter of you getting what you need in order to get it done. In some cases, when you're getting other capital, someone might tell you at the very beginning they can do it. Well, things might change down the road, and they say, "Oh, I don't know. Well, now this isn't something. It might be some excuse, or the appraisal might come in slightly lower, or it could be any type of caveat in there. But it's different, especially now." If the deal has hair on it, I mean, it's almost best to try to, come to guys like you.
Yeah. I mean, like we used to joke about, hey, people would be like, yeah, let me see what else is out there. I'll circle back with you type of thing. And like back in the day, I don't know, we would get, back in the day, I mean, like in the last few years, we'd probably get whatever 10% or 20% come back. The last few months, it's been like 100% because it's because right now it's the education phase, right? It's the denial / re-education phase of the market, where it's like, I'm not ready to pay 12.99 and 3. I'm used to 9 and 1 or 8 and 1 or whatever the case. I'm not ready yet, and that's fine. And chances are the deal that they were buying probably isn't ready yet either, because that deal can't support that. But I don't know. In our opinion, I'm always pro having different types of financing options. I'm not encouraging, if you have your own private capital, you have a hard money lending company yourself, I'm not encouraging you to be the jack of all trades. Like, Bryant's an expert at what he does, and Chris and I are experts at what we do. Like, it's not like I'm going to whoever his capital sources are and I'm going to turn into, a placement of capital. Like, that's not my business model. Just like Brian's business model isn't to go out and raise tons of capital to go, lend out private capital. Right. So whatever part of the business you want to be in, encourage you to kind of go down that road.
Yeah, I think the probably the quote of this podcast is the re-education phase, which is a really nice way to put it. Yeah, it's a nice way to put it, and it's pretty accurate too. So that's probably a good takeaway for anyone listening, is that, get your ducks in a row depending on what your lending model is, and put that out to your audience. It's like, here's what it looks like now. Here's what here's what your options are now. Here's what the world of real estate lending can get done. So yeah, we definitely appreciate you taking the time. You do have a unique perspective, and you have eyes on a bunch of different things, which is very cool to hear about. So yeah, thanks again for coming on the show. Where can people find you if they want to reach out with a deal or a question or anything? What's the best way to reach you?
They can go through the website, www.mafgllc.com, or they can always ping me at 888-350-9996.
Good stuff. Yeah, thanks again for taking the time. Everyone else, if you haven't done so already, and just a reminder, check out hardmoneymastermind.com and join the conversation with us and all the other private lenders. And we will see you next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.